From the morning reading, up, down, volatility. The SPY closes 16 cents lower, ACAM higher after earnings per share. Tesla, EXPE, Cisco gain after hours. 2 of 9 sectors moved higher on Wednesday. XLV, XLK, and XLU were the strongest sectors, while XLB was the weakest sector. Oil fell $1.02 to close at $27.33. Breadth strengthened as advancers led decliners 1.13 to 1 on the New York Stock Exchange, and decliners led 1.02 to 1 on the Nasdaq. Another volatile trading day with futures up overnight and the SPY gapping higher on the open and rising to a weekly high up more than $2, followed by a pullback to opening levels, another rally to near highs, and a final pullback to finish down 16 cents for the day. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:16 a.m. Central Time, and I'm recording this in preparation for the market day of February the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report, and we definitely have a night in which it has been very, very active. We just set a new intraday low in the Globex activity. We hit 1802 on the S&P futures, undercutting the previous swing low. We are down almost 40 points in the overnight. At the time of this cut, we are down a little over 2%. Russell down about 1.5%. Nasdaq futures down over 2%. In fact, they're the weakest at 2.25%. Dow futures also down 2%. Crude oil being crushed, down over 4%. The euro is up about 0.4%. Bonds are way up and setting new highs themselves, new 52-week highs, up 1.7%. Gold up almost 4% as we clearly have a rotation to safe haven status. China still closed. Hong Kong, though, is down almost 4%. Japan's down well over 2%, as is Germany and the United Kingdom. In terms of macroeconomic reports for today for the United States, you had the weekly variety of the unemployment claims, and you had Fed Chair Yellen testifying, though not likely to say anything new versus her statement and her earlier testimony. But it's always a wild card. It's always possible. Certainly natural gas storage is also on the docket for today, as is the 30-year bond auction. So depending if you trade those markets, those could come into play for you as well. And looking forward, we have core retail sales. That was expected to be the other big report for this week. And along with that, the retail sales and import sales and the preliminary University of Michigan Consumer Sentiment Report. And you have another FOMC member, this time Dudley, speaking as well. So pretty big slate of macroeconomic reports for tomorrow for the United States. In terms of current volatility conditions, obviously this is as of the close yesterday. I'm sure we're going to open up way up, but the short-term VIX was a 25.5 yesterday. Skew relatively benign at about 120. IV percentile as of yesterday's close again was a 45 on the S&P, a 59 starting to climb there on the Russell, a 60 on the Nasdaq, and a 58 on the Dow. There were no standard deviation moves put in the last 2 days in terms of close to close by any of the 4 indices, though we've had quite a bit of intraday volatility. And indeed, in the morning reading, one of the authors mentioned about the up, down, up, down. Let's go ahead and go to the chart, and you'll see what we're talking about. There's been a lot of wicks here. Look at all that volatility. And then yesterday we had the inverted hammer, which, you know, sometimes is taken as a context of being a reversal signal and a bullish signal. You had the big wick here with the rejection off the lows. You had the spinning top, the inverted hammer, and then, but obviously something happened in the overnight, and we have a total breakdown and now an undercut. Now the real question at this point is, where do we close? Do we reject off these overnight lows and go running back up and leave another big wick here? Or do we get an actual close below 1800? And that's the mark that we've been watching for as likely to set up for another significant bearish leg down. We are on the thin ice. We are out on the edge of the cliff. Use all of your favorite cliches, but they're all in play right now. We get a close below 1800, and we likely will see 1750 before it's over at the very least. In fact, let's go ahead and go to the weeklies just to get some timing and get some feel for this. You see how important this area is. The swing lows from this October were here. We've already undercut the August lows. We've undercut the most recent low, though by just a few ticks. It's still in the area. So we're still, can call this area support, but we are certainly watching to see if we get that close below. If we get the close below this area, we are likely going down to at least 1750. You see this swing area at 1733, but we probably are coming down into this area somewhere, and that will certainly put the overall market into bear market territory. So that's what's at risk here. If you look at 2134, the not too long ago high, and where we are right now, we're heading towards that 20% bear market territory with a breakdown below this area. So that's your S&Ps. As you heard in the morning report, the others were also breaking down. Here's your Russell, and it just continues to make lower and lower lows. Nasdaq, again, a breakdown, and this one's definitely undercut the recent swing lows. We want to see a close, though, and then the primary support would be about 3675 area for the Nasdaq if we get and have a close today below this. Now, when all the cash participants come into the market, when the cash opens up, that's going to matter, and it's going to see where that goes. But this is definitely setting up to be a pretty interesting day without a doubt. The Dow's been holding up a bit better. Remember the Dow, that's 30 big cap, dividend paying companies, to a lesser degree than bonds and gold. This is where people rotate money when they need safe haven status. So normally the sequence we expect is that the high beta, and that would be your Russell and your Nasdaq, would lead the way down, and then followed by the S&P, and then last the Dow. And usually the bottoming formations come in the same order, that the Russell and the Nasdaq would be expected to bottom first, and then the Dow probably bottoms last and starts to have that retracement. But right now, we don't see any significant signs of bottoming, especially if you look at the other instruments. Right here is our bonds, and I'm still on the weekly chart, and you can see we have blown through the prior swing highs on bonds. And then let's look also at the volatility, and again, we're still on weeklies. You can see we're up here, we're flirting with that 30 area right now, just below 29. And we've not had a close as high as we are right now. Of course, we're a long way from a close, but we've not had a close this high in the VIX in a very, very long time. You got to go back several years to get a close that is up in this area. So volatility is definitely signaling significant market weakness. Bonds are clearly signaling that. Let's take a look at gold. Look at gold. Gold is in a total breakout, and they've had a number of kind of false breakouts in the past, but this one, if it closes up here, that is clearly going to be a breakout territory, and you're going to hear a lot of chatter from the gold bugs about the turn is finally here. This will really get them churned up. So quite a bit of stuff going on with the charts today. Let's go ahead and go to the daily report. And this is just about as ugly as it can get. Just about everything is pegged to its worst setting. Phase 1 in terms of the intermediate term phase opinion, bear flags is the expectation. So we expect that the bearish legs are longer, the bullish ones, though violent and significant at times in a bear market, to be shorter and to fail repeatedly until proven otherwise. We're in market and correction from our IBD accumulation distribution at a D- on both the S&P and the Nasdaq. GMI index actually did come up one notch with yesterday. Still a sell signal though at the 1 out of 6. That signal has been in place since December the 10th. That author retains a very happy and content 100% allocation in cash during all this mess in recent weeks. In terms of decision point scoreboards, we have a couple lone short-term green signals, but other than that, a lot of red across all time frames and all markets. Position sizing opinion is at 0% on the investor, and then on the active trader is at less than 50%. If we get a close above 30%, that signal will also go to 0. The intermediate term market posture is very bearish with a very bearish sentiment line, and it's just barely holding on to that status. If we indeed have a close anywhere close to where we are right now, this will drop into the severely bearish camp. Dow probably will come close to that as well. Nasdaq and Russell are already in the severely bearish camp. Our hedge warning status is currently at a 2+. If we get a close below 1800, I expect that that will go to threshold level 3, which is our highest warning, and that would be crash warning area. That is not the prediction of a significant down move nor how far it would go, but it is an opinion that the risk levels are present for such a thing to happen with a much higher probability. In terms of the specific warnings, market in decline, still flashing. VIX futures obviously well up over 18. We're in a market and correction status on our distribution day count. On the volatility ratio, we actually had a first day close beneath that signal, which is a signal to us to look for reversal patterns. That reversal pattern could come today. We'll have to see with this if we see some sort of capitulation and flushing with high volume to where this overnight action sets up a reversal pattern. But right now, it hasn't done that. VIX phase, of course, increasing. The week out expected move at the time of yesterday's close was 58. I expect that that will increase with today's open. In terms of intermarket risk aversion indicators, we got all 5 flagging as risk off. And then finally, the fear and greed index in the extreme fear area at a 16 and dropping from the previous close and from a week ago. So pretty lethal there. In terms of special opinions, we are outside the acceptable conditions for novice traders on all 3 of these strategies. Option income strategies, cover call strategies, and put selling are all outside of the expected areas. In terms of sector specific, we are a sea of red here with the exception of the 2 most defensive sectors, consumer staples and utilities, holding up the best in the market, and that is definitely a reflection of a market that's acting like it's in a bear market or even a recessionary phase, is the postures that you're seeing from the way people are recently trading. Not yet in a bear market, nor are we clearly anywhere close yet to a recession, but there's an awful lot of activity that is acting like we are. In terms of percent change, you see yesterday healthcare did put in a nice bullish move. Information technology also up, and then everything else down. And you see materials and energy and financials leading the way down. Financials have really been hurt lately. If you look at some of the individual major components from the financial sector. It's some really, really ugly charts going on there. And this was supposed to be the year in which bonds were supposed to be down and the financials were supposed to be up. And we clearly have gone the exact opposite direction there. In terms of, I think that's probably enough for today. A couple things to keep in mind, and let's go ahead and pay a little bit of attention to this right here. If you find that this is helpful to your trading, we do this for free, but we certainly love those pats on the back, and the way you can do that is you can like us on YouTube, you can retweet us to your Twitter followers, to your StockTwit followers, you can forward the emails and other hyperlinks and so forth to your trading partners and say, hey, this is doing something that's helping my trading. We greatly appreciate that. And of course, with YouTube, you can subscribe to that channel and you'll get an email alert that content has been posted. When you do get that email alert, we do suggest that you wait a couple minutes, let that finish loading up in a high def level. And indeed, if you look for the little gearbox, especially if you're on Chrome, you can take that gearbox, you can change the playback to high definition. That makes the charts look a lot better, etc. And there's also the ability to change that speed in which that video plays back. And most people can understand and have full recognition at a playback speed of 1.5x. And that'll take that, that 15-minute video and turn it into a 10-minute. It takes the 20-minute video when we have a lot more going on and turns it into about 13 minutes. So that can really help your morning productivity. Also, I'll go ahead and share a little bit about daily price guides. When you get a day like we've had in recent days, the ability to have all of your support and resistance levels all stacked up, and you see these are our daily price guide subscription product. It's a very friendly value. That's only $25 for a set of 8 futures markets. In this example, I've got the crude oil, the euro, the bonds, and the gold set on this. And you can see there's fib retracements, there's trader pivots, there's 2-day highs and lows, there's all the classic support and resistance areas. You have your market profile and volume profile, value area highs and lows, the POCs and so forth. And indeed, I color code this. You can go to the video and get more information on how this is designed. But this thing is just flat out packed with information and is all provided in an email to you each morning before the market opens for a very nominal cost of $25 a month. So that is absolutely invaluable to my trading, and I would say that you would find it the same for you as well. And you see the 8 markets. On the other guide, you have the 4 indexes. So for example, each day I most definitely work up where are the support and resistance clusters for the S&P, and that guides my trading. And whether you're a day trader or you're just simply timing entries and exits into your longer term trading, I'm very much on that as well, using these tools to do that. So there's that. And I think that's probably enough for today. I'll flip through the rest of these. If you see something of interest, just get the hyperlink, hit pause, hit the hyperlink, and go there for additional information. Disclaimers as always, hit the pause button if you need more time to review, and you see the hyperlink at the bottom for the full set of disclosures. We look forward to being back with you tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.